Awesome. Thanks everyone, and thanks for those of us who are joining and listening, as well as our panelists. And thanks for joining us for today's Sidecar session. My name is Shri Bashyam. I'm the COO of Sidecar, and I actually also have some prior experience as a founder and as an executive in the secondary space. And for those who don't know, Sidecar is a platform where fund managers can come to efficiently handle many of their venture fund needs, including many of the boring back office stuff that we don't find so boring, like entity formation, entity maintenance, including things like K1s and transfers of interest, distributions, and then ultimately even wind down of a vehicle. These are for use cases such as syndicated investments and co-investments. And the folks we work with tend to be syndicate leads, emerging managers, and established venture managers. So today we're going to talk about the surging secondaries market and what syndicate and venture fund managers should know about secondaries deals, where secondaries may fit into a venture investment strategy, the challenges and pitfalls to look out for as you get into deal flow and transactions in the space, and trends in the market as well. We're honored today to be joined by Max Harris, Steve Ogunro, and Michele Asculi. And Phil Gurman, I believe, is going to be joining, though having a few technical difficulties logging on. And they're going to share their experiences and expertise in secondaries with us. So to get started with, maybe we'll do a quick round of introductions, and then I'll get into a little bit of a background on where the market is today. And then we can get into the discussion with the panelists. Along the way, please do feel free to submit any questions you have into the Q&A box on your screen. And then we reserved a little time at the end to go through those questions, and I'll kick them out to our esteemed panelists to see what their thoughts might be on them. Steve, you want to kick it off for us with a quick intro on yourself and your firm?
Sure. So I'm Stephen Ogunro. I'm a partner at Crosswork. So we do both direct investing and secondary investing in late stage companies. Over the last 2.5 years, we've invested in around 40 companies with an average last venture and valuation of around $4 billion. Obviously we look to invest at a discount to that, which we have done successfully. One of our companies was acquired in May, a company called Audit Board. It was the biggest acquisition of a venture-backed company in 2024. And we're looking forward to the potential IPO of Cerebras, which is the biggest AI chip company in the world. Our focus tends to skew towards technology. Enterprise SaaS is pretty important to us. And we've invested heavily in AI as well, obviously late stage AI. I was at Goldman Sachs and Morgan Stanley previously. That's the overview here.
Awesome, thank you. Max, would you like to go next?
Yeah, sure. Hi everyone, my name is Max Harris. At my previous firm, Ticker, I was the co-founder. We focused mainly on LP secondaries. So we played a lot in both structured product and direct secondaries for LPs of mid-market funds. Looking mostly on the venture side, did a little bit of exploration into some growth and buyout funds as well. And actually recently started a role at Monarch Markets, working on the supply side partnerships team and building out future infrastructure for secondaries transactions in the private markets.
Awesome. Thanks, Max. And congrats on the recent move to Monarch, which is pretty cool. Michele, you want to go next, and then maybe Phil can bring us home?
Sounds good. Thanks, Sri. Thanks for having me here. My name is Michele, or Michael, if that's easier for you. And I run ARMYN Capital out of New York. ARMYN Capital is a venture firm, and we manage different investment vehicles, early stage, growth, and late stage. We're active both in the primary and secondary markets, with over 30 investments active in the portfolio currently, different industries in defense, AI, and fintech mostly. And I've been investing in secondaries since 2019. in different flavors, whereas those are direct secondaries or double layer secondaries or tender offers. And I'm looking forward to the discussion here today. Thank you.
Thanks, Michele. Phil, thank you. And you want to quickly introduce yourself, and then we'll get into the discussion.
Yeah, thanks, Shri. And sorry, I had some technical difficulties joining. I did get in on my phone, which is a classic sort of swap the laptop for the phone Zoom trick. But here I am. So yeah, thanks for having me. Exciting to be here. Happy to give some background on myself. I've spent a little over 6 years in the secondary markets now. Started my career off at Fidelity Investments for a number of years before joining EquityZen, which is a secondary markets platform. I spent those years in a number of roles from the retail to institutional space, and then was able to join Nasdaq Private Market in early 2024. I joined the capital markets team, where I continue to see a variety of secondaries take place. And Shri, are we doing firm backgrounds as well right now, or just personal?
Sure. Feel free to give a quick synopsis on your firm as well.
Yeah, so Nasdaq Private Market, we've been around for a little over a decade at this point. The tender business and the buyback business is our legacy business. It's over a decade old. Nasdaq originally acquired this company called Second Market in the mid 2010s, with the goal of building relationships with companies from an earlier stage as companies are staying private longer. In 2021, Nasdaq actually spun Nasdaq Private Market out, and remained, the lead investor in the business alongside Goldman Sachs, Morgan Stanley, Citibank, Silicon Valley Bank, and Allen and Company. In more recent years, we've closed an additional round of capital, including from those existing investors, but also adding UBS, Wells Fargo, BNP Paribas, the JoJo, DRW, and more recently Bank of America, Merrill Lynch. So to date, we facilitated over 50 billion in transaction volume, secondary transaction volume, amongst 750 programs and for 160,000 participants. And this year, we're excited to have introduced our Second Market Investor Workstation, which will hopefully allow investors that are participating in this market to consume deal flow on a more regular basis.
Awesome. Thanks for that. We have a breadth, depth, and variety of secondaries experience on the panel today. So pretty pumped to get into it. I'll start off with a lay of the land, and as a PSA, do feel free, everyone, to just lob your questions into the chat, and we will get to them towards the end around 3:45 Eastern. But just to set the stage a little bit, on our end at Sidecar, we have seen a major uptick in secondaries activity this year. And by secondaries, I'm referring to secondary sales of private shares, not to be confused with transfers of LP interests in funds. And so these secondary sales of private shares are where an investor is purchasing shares from an existing shareholder, such as an early investor or a current or ex-employee, rather than buying those shares directly from the company or the issuer of the securities. That latter thing is typically what's called a primary issuance. Investors might do that in an angel seed round or Series A or Series D type of transaction. And typically these secondary deals that we're talking about here today are done in growth stage pre-IPO companies and not the early stage companies. And just a little bit of data on where the market is at and why we feel we're seeing an uptick in activity. Pre-IPO transaction volume was up nearly 50% year over year in the first half of the year, according to Caplight. This is up to a number of $700 million in volume that they measured. Forge, another firm that tracks the space and is a leading platform for secondaries, they look at the bid-ask spread to gauge market health and activity. This is basically the delta between where buyers want to buy shares and sellers want to sell shares. And in Q1 2024, they had a median bid-ask spread on their platform of 9.5%, compared with 21% in Q1 of 2023. So we're seeing the bid-ask spread tighten. And the tightening of this spread suggests that buyers and sellers are actually coming together to align on price, indicating a more active and liquid secondary market. Further, on Forge, the total volume of IOIs, which are indications of interest, grew by 45% in Q1 24. To be sure, this is not like a market clearing transaction metric of where trades happen, but rather what's the pulse more up funnel on buyer and seller sentiment and interest. So this indicates a significant increase in activity within the secondaries market as more buyers and sellers are expressing interest in doing deals. In the first half of the year, pre-IPO companies outperformed the Nasdaq 100 or the QQQ ETF, and that's as measured by Caplight and their top 20 index. And that was up 25% in the first half of the year. The surge in these pre-IPO markets is led by companies like Stripe, OpenAI, Anthropics, and X.AI. You might see a bit of a theme there around AI. And all these companies have seen their secondary market valuations increase by about 10 to 37% over their last primary financing. Sometimes these primary rounds were down rounds. And so this is an indication of like market interest is back. Buyers are willing to pay above the last round price. And again, another kind of indication of a pickup in activity. Closer to home, we've seen secondary deals on Sidecar up 42% year over year on our platform, where deal organizers can use our SPVs to arrange secondary transactions. We've also seen an increase in LP participation in these deals by over 30% over that same time period. So with that data to kind of contextualize the uptick, let's dig in a little bit with our panelists. So let's start here. Phil, are secondaries back?
Shri, yeah, it's a good question. And, from a relative perspective, I think you could say that secondaries are back. I think you did a good job of setting some landscape, but to paint a picture, going back a few years, as one would expect, 2021 was certainly a boom time, both for the broader venture landscape, but for secondaries as well. And myself and those that worked in the secondary market at the time will recall, secondary trades were frequently being, organized and struck at premiums to very fresh rounds. Companies like DoorDash and Klarna were, taking increasing, billions and billions of dollars within months of raising the prior round of capital, and large global, brand name venture investors were willingly paying these prices, and that led a lot of investors on the retail side and from the secondary perspective to say, hey, we'd love to get in on these same deals. And in fact, we're actually willing to pay the same premiums and sometimes even more. So, NPM similarly at the time, we were doing broad-based liquidity programs for, even Series A companies and early stage companies at 30% plus premiums in this 2021 period. So, that was kind of, the boom era. 2022, we saw things, correct as the Fed began to raise rates at a historic pace in 22. Secondary market receded, alongside it, and we saw a bit of a buyer strike, as we call it, here internally, with investors kind of receding away from the market. And secondary markets are certainly very like a risk-on, rate-sensitive market. So when money's easy, and the consensus is that it will become easy again, secondary markets tend to open up. And we felt that recovery. Since late 22, early 23. Really in 2023, we started feeling this more. And so while we're not, at the 2021 peaks, and we may never be again, it's probably a healthy thing, that we're off the 22 lows and kind of on a more healthy trajectory and growth rate. So, to give a few figures as to, where we're at this year in comparison to prior. When we look at our broad-based liquidity programs, and these are tenders, buybacks, and auctions that Nasdaq Private Market runs for companies, meaning they're putting together pools of liquidity for investors to purchase in a secondary fashion. We've already processed, over $4.2 billion in volume during the first half of this year, which is up from the last, and we see, a flush pipeline through the year ends. Sure, you hit on a bid offer ratio we look at something similar here at Nasdaq Private Market. 2023 of all of the bids and asks that we saw, the ratio was 30%, 36% bid, 64% ask. In 2024, at least during the first half, we've seen that that bid ratio increase to 47% bid, 53% ask, meaning more buyers are entering the market and seeing secondary deal flow as an opportunity to participate in. And then concentration, we similarly see that as a story to tell as well. 60% of the order value we've seen in 2024 has been in 20 issuers in the first half. And of that, AI makes up over 20% of that sector, or of that segment, and fintech and aerospace defense trail closely behind.
Awesome. Thank you for that insight. And I think historically we've seen secondary markets have like a concentration in a certain number of actively traded names, and then more of a long tail with some more thinly traded names. And over time, we've seen the aperture of that widen. But if you think about, at some point there was like 1,000 unicorns, that might help contextualize how many of them are actively traded. Stepping back a little bit, Stephen, you have a bunch of experience doing secondaries at Crosswork. It might be helpful to walk our audience through how secondary transactions work, kind of like the deal steps. It's not like a typical primary offering where you're investing into maybe like a safe note of a pre-seed or seed stage company. These secondary transactions have their own process. So maybe if you want to touch on that and give like a high level overview for everyone.
Sure. So just before I do that, I should probably say, and I think this goes for all of us, is that nothing that we're saying on this call is investment advice or should be construed as investment advice. And obviously investments in private companies are risky and illiquid with the potential for loss of all capital. So that's the legalese out of the way. In terms of how secondary transactions work, yeah, I guess there are a wide range of types of secondary transactions. I think you touched on the LP secondary transactions. I think that the most voluminous type will be the direct secondaries, which are investments, that are being made onto the cap table, through a purchase from an existing shareholder. So that could be an employee, could be an early stage. It could be an earlier multi-stage venture fund, just not directly from the company in general. Then you have special purpose vehicles, which are simply companies that are set up with one investment in mind, into a secondary security, and so a common example would be an SPV that invests in SpaceX, or in OpenAI, or in Anthropic, and then a somewhat controversial but still popular format is the forward contract, which is simply an agreement with an existing shareholder to purchase shares at some future date with cash being advanced today, in what is effectively a loan. So those are the three types. I'll concentrate primarily on direct secondaries just to since they're a lot more straightforward. The key sort of overall steps are first, you identify, if you're a buyer, you identify a seller, right? And there are multiple ways to do that, but I'll come back and talk about them. Once you identify a seller, you come to some agreement on price and terms. Presumably, you've done your due diligence. Presumably, you have information rights or some form of information access. It's not always the case. This market is very information asymmetric, and then once you agree on price and terms, you cause the issuance of a transfer notice. So you enter into some form of either standardized LOI effectively, or a custom LOI. But the purpose of this is the multiple purposes of it, but one of the core ones is to provide notice to the company that you're seeking to effect this transaction. This then triggers something with most companies, which is the ROFO, or the rights of first refusal. So this alerts the company to the fact that a transaction has been contemplated, the opportunity to purchase at the same terms if it's inclined to do so. Sometimes it might reject the transaction and what we've heard, we've heard all types of reasons for rejecting a transaction. Some to make you scratch your head, frankly. And then, but most of the time, a transaction will go through, and then you get into the discussion with typically the company's counsel that usually has some form of standardized documentation for the transaction. So your review suggests changes if appropriate, and then you execute. Then there's some form of closing, wiring of funds and transfer of ownership. So that's the high level overview of the direct secondary process.
Awesome.
Is that a shift or? Yeah, I can go into more detail, but we're probably limited on time.
That's right. Yeah. And this is really intended to be like a 101 level intro to what's going on in secondaries. I think if we have interest from folks, we can always get to the 102 coursework. You indicated a couple really interesting wrinkles there that I want to just put a pin in and come back to, which are around info asymmetry in the space, the use of SPVs, and then forward contracts. We'll come back to that, I think, in a different question relating to things to look out for in these transactions. But thanks for that overview of the transaction process. Most importantly, that the issuer plays a substantial role in that they have a right of first refusal. They could decide to waive or exercise, or they could basically say, oh, selling shareholder, don't sell those shares to Shri, who wants to buy your shares. We'll buy them from you on the same price, or assign it to our existing cap table to purchase from you. And so that's kind of like their election to make. Moving on, and I want to be cognizant of time. Max, perhaps, as someone who has been a founder in the space, and now you're working at an ATS broker dealer who's looking to get involved in the space, what are you seeing, or what trends have you observed in the market?
Yeah, actually, I think Steve's explanation there was a really good intro into a lot of the trends, which is faster and more simplified infrastructure from an end user and purchaser perspective. A lot of what Steve went into there are things that fund admins or back-end infrastructure that plug into these brokerages or ATSs or wherever the transactions are flowing through. That type of thing can be somewhat automated and processed in a way that makes it a lot better for users. And as a whole, kind of expanding the scope of potential distribution for secondaries, along with kind of addressing the forever undercapitalization of the market. Now, a lot of the time that undercapitalization refers more towards the private equity side and the LP transfer side. But as a whole, the direct secondary market is still very much undercapitalized, especially for kind of larger deals. You'll see smaller buyers trying to piece together into a larger deal, but those larger deals often kind of float as sell orders for long periods of time. Also, without talking our own book too much, there definitely is an increasing trend towards these ATS broker dealers, which ATS is alternative trading system. You can kind of think of it as a private stock market of sorts. It's a way for brokers to enable a little bit more fluid transactions, and kind of serves as a private market of sorts within a broker dealer. And then again, trying to respect time here and not go into too many things. One interesting kind of side trend that I've seen in the last few months, trickling down from kind of its legacy in private equity secondaries, has been the use of preferred equity. not preferred equity, without getting into too many details, not preferred equity in the underlying primary issuer, but actually using preferred equity as a structure to enable secondary transactions without going through all of the onerous process that Steve just kind of dove into a little bit there. It's something that isn't super common for venture companies, but is something that might be very useful in expanding that distribution network.
Very interesting. So we're seeing some innovation happen, and it sounds like liquidity is still somewhat thin compared to other markets, and we see that show up in like the big blocks where it's kind of harder to match size for size. I don't know if anyone would want to add any thought around the trend or react to anything Max said about the use of preferred structures, or what's going on the institutional end of the market. If not, there's a bunch of juicy stuff I have to cover too, so I'd love to get into with you guys. So I guess maybe talking now to opportunity and value that fund managers might be able to see through secondaries transactions. Michele, we haven't heard from you yet, and you've done some secondaries deals. You're a venture manager at ARMYN Capital. What's the value that you see, or that an investor or syndicate lead or a fund manager might see in looking at secondaries deals? And how does it fit into your investment strategy?
Yeah, for sure. No, that's a great question. I think ultimately, as an investment firm, we're in the business of providing returns to our LPs. And secondaries are a great way to do that, but not just that. So let me address the return component, and then I'll add a couple more things that secondaries are valuable for. So in terms of returns, two things. Number one, especially during the downturn of 2022, 2023, we leveraged secondaries. Basically, whenever we identified a price dislocation in the market, in a company that we believed had the right metrics or had the right fundamentals. However, the market was not pricing it correctly for a number of reasons. For example, you have a seller that's distressed and needs liquidity and may need to sell its position quickly. He might be more incentivized to go down on price, and that's where you find the price dislocation. So we've been leveraging secondaries to basically generate alpha thanks to those price dislocations in 2022 and 2023.
I want to just double click on that point really quick, because I think there's a couple things. One is the secondary market took a substantial dip in 22 and 23, which created an opportunity to buy. Additionally, you're saying sometimes there might be distressed situations. So as we alluded to earlier, oftentimes the seller is an employee or a leaving employee or an ex-employee. When they leave, they have options, and the market standard is that these options expire within 90 days if they're not exercised. And so sometimes departing employees have a decision to make, and they don't want to leave money on the table, but there's substantial cost, including tax costs, associated with exercising these options. As a result, oftentimes purchasing on secondary for common stock can be had at a discount relative to where the last primary financing was. So if you have conviction on a company, there's an interesting opportunity in secondaries to kind of get in at more favorable pricing than in other market scenarios.
Yeah, and the same applies. And I know that we said we would mainly focus on sort of more plain vanilla secondaries, but the same applies also to investors. And without getting into fund secondaries and membership transfers and all of that, in a similar fashion, you could have an angel investor that invested in a company at the seed. The company is now valued billions of dollars, and that investor may want to buy a house or pay for tuition for his kids, and may be interested in selling. And so that could be another instance where this person may be more incentivized to sell in the immediate term, and therefore sort of have the pressure to take somewhat of a discount relative to the price. But sort of back to how secondaries add value for us too. I think because secondaries are generally in late stage companies, valued at 500 million plus, right? They also tend to be a bit more liquid, and this is not the only reason, but it's one of the reasons, right? There are more people, like more demand for late stage companies than early stage. And because of this, they're a little bit more liquid than early stage. So it's easier to sort of trade in and out of positions. And it's also easier to turn MOIC or paper markups, let's call them, to actual DPI, which is distributed cash. And so we found ourselves in situations where perhaps we leveraged a price dislocation in the market in 2022, bought a position at, I don't know, a 50% discount, and the company in the meantime did well, raised an up round, and the LP found himself, with a 100% return in a year or 2 years. And because of that demand and because of the infrastructure that we will talk about a little bit later in the secondary space, it's been also possible for us to give LPs the opportunity to trade out of those positions. And I guess the point that I'm making is that with secondaries, it's a little bit easier to do that and really generate actual returns like distributions and not just paper returns like early stage. Maybe one more thing. I think secondaries for us also are very useful for relationship building with LPs and relationship building with founders. For LPs, it's mostly when we're forming new relationships, and perhaps we meet a new potential investor and he says, hey, I'm very interested in this specific company. Can you get me access? And that's a way for us to develop a relationship if we have a conviction in that company, of course. And similarly with founders, say, primary is oversubscribed, there is no room for us to come in the primary, and the founder maybe says, hey, like we're doing a small internal secondary round, why don't you come in through the secondary? And then, we build a relationship, and whenever we're gonna have the next primary round, you're gonna be able to come in then. And the opposite also works, right? When you're invested in a company as a primary investor and you have information, you get updates, perhaps there is an opportunity to you to increase your stake via secondary while you wait for the primary.
Awesome. Thank you so much. You ran through a bunch of ways in which secondary transactions might be valuable and ought to fit into the investment strategy of a fund manager. Want to open this one up for everyone. How do you source secondaries deals? Where can people go to find these deals? And how can someone interested in secondaries start opening up their deal flow? Maybe Stephen, if you want to start us off on this one.
Sure. So we look at, we look at a wide range of places for transactions, right? So we have an extensive network of relationships in the venture and PE space, that we're constantly talking with, we talk to the guys at all the funds that you would typically know, right? So the Sequoia guys, ex-Sequoia guys, Kleiner guys, Vista guys, so we talk to everyone, we've done a pretty good job just because, so the very first secondary transaction that we looked at was Facebook, so years ago, the company that really kind of kicked this off. So we've developed a pretty deep database of sort of key employees that have moved around as well, and tend to look for liquidity, right? So that on the secondary side, that's helpful. Obviously, we're seeing some platforms now that some of these electronic platforms that that people are using as well, and we take a look at those too, and then of course for family offices, other institutional investors. There's there are a wide range of people that are active in the space, and we talk to everybody.
Awesome. Phil, from your vantage point, where can someone on the buy side source deals from?
Yeah, there's a variety of ways. I think to plug ourselves, of course, Nasdaq Private Market is operating, an ATS and a pool, an investor pool where you can access both, secondary deals and also in some cases company programs, but also, if you are, somebody that has a venture network and you've, worked with employees or you work with other investors, you can sometimes, find deal flow through the broader tech community. Just to highlight, something that we also see as far as a way that secondaries originate, to kind of go off of Michele's points or a few, examples earlier. Sometimes we'll see from an institutional perspective funds that are nearing their end of vintage. So perhaps they're 8 or 9 years into their vintage and they need to get liquidity to generate DPI as the fund is just at end of term. It can be another natural reason that a secondary block might come onto the market. And so, oftentimes those types of venture, investors will look to a broker to sell because, the work of going to and finding investors like those that might be on this call, could be really laborious. You might be really reaching out to hundreds of people to try and find your buyer. Going through a marketplace or a broker allows you to get, central access. And that's really what we're trying to build at Nasdaq Private Market is a central market location through our investor workstation where folks can view blocks across the brokerage landscape, but also the direct buyer and sellers that have access.
Awesome. Max, anything you'd add to that?
I think most of the general sources have been covered. NPM is a great resource if you're an institution. And then if you're more on the retail side, if you are an individual looking to buy into this space, there are platforms, several. I mean, if you're slightly larger, you can go to Forge, there's Augment and Hive, and without naming a bunch of names, there's a lot of ways to get into the space. I think it's probably easier than ever to find and close some sort of basic secondary deal if you're not very picky, but it's also probably harder than ever to really have a good inside knowledge of the landscape and have good connections because these aggregators are starting to eat up more and more of the deals and more of them are going to platforms and kind of getting pulled together versus the way it used to be with a bunch of phone calls to different brokers and different fund managers and whatnot. Another potentially interesting source source is with continuation vehicles. I don't know if we have time to get into stuff like that. But if you are a fund manager or, have a little bit of an inside knowledge into some fund managers and an end of life funds, looking into singular, relatively a small number of asset continuation vehicles can be a good way to get into the secondary market as well.
Very cool. Why don't you just give like a really quick definition of continuation vehicles for everyone so they can understand what that is?
Yeah, sure. So more so in private equity funds than in venture funds, but they do exist in venture. Continuation vehicles are when a GP, so a general partner or manager of a private fund, will kind of pull off one or more of their assets in their fund. Normally, it used to be sometimes it was the distressed assets. Now, a lot of the time it's actually the trophy assets that they want to continue to manage and build returns on. And they'll pull those into a new vehicle where they'll either let their current investors re-up into that vehicle, or they will find new investors and provide liquidity to their previous investors. So those new investors effectively get in at a secondary basis. And if it's a single asset, then it's very similar in a lot of ways to just buying that asset on the secondary market, but you don't have to worry about managing it yourself.
Awesome. Thank you. Want to just give a quick PSA again for people to feel free to put questions into the Q&A. We still have plenty to go through. And so we're monitoring that and we'll come back to the Q&A. Switching gears a little bit, let's discuss some of the challenges and things to look out for in secondaries deals. When dealing with employee shareholders or intermediaries, how to manage execution risk. There are things like maybe there's a potential for double dealing and making sure the shares are secured, or, you know, someone walking back a transaction because the broker never really had the allocation, or someone says, I got a better price somewhere else. You know, if you're a deal organizer and you have, you know, LPs or a syndicate members, these deals might fall apart, and you got to always be sensitive to that execution risk. Steve, you earlier touched on things like information asymmetry, dealing with layered SPVs, things like that, about forward contracts versus owning the shares outright. So I want to just put this out to everyone for, you know, if you had to identify, like, what are your top 2 or 3 things to look out for, and, you know, where there's potential risk or things that need to be run down a little bit, what might you suggest those will be? Michele, maybe we could get started with you this time.
For sure. Yeah, I think Stephen touched on a very important point earlier, information asymmetry, right? And without getting too much into like the regulatory side of things and non-public information and how you define that, I think what you always have to ask yourself is, why is a seller interested in selling this stake, right? Especially if it's, you know, highly performing company in their portfolio. And again, you know, the rules are similar but different, public versus private markets, right? But the disclosures are certainly a little bit less than in the public markets. And secondary markets operate under this buyer beware principle, right? And that's also why a lot of these secondaries are catering to qualified clients, qualified purchasers, and very sophisticated investors that are supposed to know what they're doing, and they're supposed to know how to evaluate such investments. And so, you know, when you're seeing a deal at a 50 or 80% discount, it may sound like a really good deal in that moment, but without actually being able to sort of back channel and do diligence, conduct diligence on the opportunity, you're probably in for some pain later down the road. So it's always very important to verify and conduct due diligence, especially in secondary transactions. But back to sort of the challenges and how to mitigate them a little bit. I think, you know, the secondary world and secondary transactions move very quickly, and things change and evolve very rapidly. And so it's very important, at least I found in my own experience, to communicate and over communicate with LPs in terms of what is going on, especially when you're pooling capital for a specific opportunity in a specific company. And I sort of tend to over communicate rather than trying to, you know, savage things at the end, because maybe I did not really let the LP know of, you know, whatever was going on in that moment in time. Maybe one or two more quick things, I guess. You know, for direct secondaries, this is not an issue, but when you're layering into somebody else, it's always important to verify chain of custody, and is, you know, the first layer actually purchasing the stock, right? And also, most important, for very hot sort of names in the secondary space that some of you have mentioned earlier. I read this great statistic today from Caplight, I believe, that basically for every $100 invested in like hot SPVs, only 20 get filled, right? So if you're investing, or you're offered an SPV into, I don't know, call it SpaceX, and you might think that you're getting the allocation until the very end, there are probably very good chances that you will not get it, or if you get it, you'll get a lot less than you thought. So it's important to mitigate that effectively, and again, communicate with LPs and have trusted sort of partners and sellers that you're working with to sort of mitigate those risks.
Awesome, thank you. Stephen, anything you'd add in terms of what to look out for as a manager or on the buy side in terms of due diligence, or like pitfalls when looking at secondaries deals?
Sure. So before I answer that, I'll just, something Michele said is really important to highlight, is that disclosures are everything from the point of view of dealing with your investors, your limited partners. Disclose. You know, I can't sort of I can't state that, hard enough. In terms of other things, to look out for, I think that, obviously, as an end transaction, there's closing risk, so what we try to do at transfer notice or term sheet stage is have it be sort of semi-binding, if that makes sense. The last thing that you want to do is put a bunch of work into getting a deal done only to have the seller kind of get cold feet or claim to have a better deal elsewhere. So we do this sort of, this semi-binding thing. One of the things that we have that really helps us a lot is we actually have a really large advisory board, and there's a purpose to it. It's small when you break it out into sectors, but in aggregate, it's significant. We have about 80 guys. So we have people like the former CEO of Spirit Airlines, the former chairman of Playboy, the former CFO of Yahoo, some senior execs at Stripe. So whenever we look at a company, we're able to solicit really sort of strategic opinion, in terms of the industry. So in addition to kind of, to attempting to secure information rights and talking to partners, in the industry, to try and get information, we really, utilize our advisory board. So for almost any company that we'd like to invest in, one of our board members either has a direct relationship with the company or knows the industry intimately. I remember there was a company that we were really excited about investing in. We developed a thesis and we found something at a block at a good price. And I called one of my board members. I said, look, we're thinking about this company. And he said, hey, Steve, are you having me followed? I just had lunch with the CEO just now. Right. So that kind of thing is really helpful to us. Other than that, so on the SPV side, as I think as Michele said, you have to be able to do due diligence on the vehicle, very important. Obviously most of these vehicles are domestic. If they're offshore, they add, other layers of complexity, and sometimes you need a good lawyer to give you some CYA as well, right? Yeah, I mean, there are more risks, and sometimes you deal with them as you see them.
Awesome. Thank you for
If I
that.
could quickly add one thing, it sounds like basic advice, but especially if you're going through platforms or kind of brokerage aggregator systems, as bad as this sounds, and it is unfortunately true, and really only applies at the very early stages of a deal. But if it sounds too amazing, it might be too amazing. If you're getting a $500,000, access to direct cap table at SpaceX right now, unless you know the reason that's available, it's probably not going to be available, and there's something going on in that listing. So that really only applies until you actually start getting it into the diligence phases. But at a high level, it is something to look out for, because those types of deals will pop up that just aren't actually tangible.
Got it. So this is still a fairly opaque market, and it's still evolving, and lots of things to look out for, including kind of who are the intermediaries that are sourcing deals for you. I want to make sure we hit a couple of the Q&A questions that came in. So let's maybe do those quickly, and then if we have time, we could go through one or two more. So we have a question here about, do you think the increase in private secondary liquidity will cause PE shops, and I'll add to that venture shops, to change their strategy and timeframes of their own vehicles and how they do their investments? Perhaps, sorry, did someone want to jump in and take that one?
Yeah, I was going to say, I think I could address that one, Sri.
Please, go for it.
Yeah, so I think, thinking about venture funds, there's a traditional kind of rule in the venture community, at least for the standard fund, that you can only invest like 10% of the fund in secondary unless you register as an RIA. And we're increasingly seeing venture managers register as an RIA, traditional early stage venture managers. register as RIAs or as an RIA to be able to invest in secondary as their portfolio companies mature. I don't think that generally the 10-year vintage is really changing. That's something, at least over the course of my career, I've seen as pretty static, but we are seeing, funds increasingly look to secondary, including, tier one platinum global investment vehicles and firms look at secondary. And we're also seeing, dedicated secondary funds or opportunity funds being set up by venture managers, where they're basically setting up a vehicle that's purposefully built to invest in the winners in their portfolio, and it can take advantage of investing in those winners through secondary.
Awesome. Thanks for that, Phil. We have one more question from Jack. What are the standard discounts that you're seeing for single name equities transactions? And then what might be the prevailing, market discounts or premium for LP interest or fund interest secondaries?
I can actually take that. I have the Jefferies and data pulled up here from half one.
Great. Max, perhaps
yeah.
you could do that one quickly, and then if anyone else wants to share additional market color, they can as well on that one.
Yeah, so venture always tends to lag private equity in terms of the pricing. So you'll see higher percentages of NAV being traded for private equity deals in general than in venture deals. It seems like, according to some half one data that we have in Q1 and Q2 of this year, venture, you're looking at for LP portfolios, to Jack's question, you get roughly 70-ish% of NAV. Really, with any multi-asset deal, you'll see a drop in the pricing because due diligence and valuations are a lot trickier once you have more than one asset. With single assets, venture is seeing in the neighborhood of 85 to 90 sometimes, depending on the asset, all the way down to 60 to 65 for some assets. And then in more private equity focused deals, it's actually been pretty stagnant around the 90 to 95% for single assets. And that generally tracks with the types of deals that I've seen both at Ticker and Monarch in the market in terms of pricing. For LP portfolios, you'll always see a bit of a lower pricing. And for single assets, venture is starting to level out probably around that 80 to 85% NAV. Private equity a bit higher, around 90, 95% NAV, or sometimes even at a premium in rare cases.
Awesome. Thanks for that. And just as a little bit of context for everyone, typically in the secondary markets, the way things are priced are at a discount or premium to the last primary round of the company. So that's why you're referred to as a percentage discount. Anyone else have any color they would want to add on what they're seeing in terms of prevailing market discounts in secondaries?
And maybe I can quickly add that it's entirely company specific for single asset deals, right? And at least for the companies that I look at, the premiums are sometimes somewhat common. And if they're not premiums, they're on par with either the last primary or the last tender offer, right? And then it depends on how you account for fees, because say there is a tender offer in SpaceX, and the tender offer is at $100. There are intermediaries in between yourself and the tender, right? And so you might have a broker, or you might have a manager that's charging a brokerage fee or a management fee, or carried interest. And so the price, that's how the price goes from on par to premium.
Awesome. Thank you. So it depends name by name where the demand is, what are hot names and not. There's another question that came in, how does pref trade differently in secondaries versus common? Maybe Phil, if you want to touch on that one.
Yeah, sure. So it's a really good question, and it does make a difference. So if you think about a preferred share class, you're usually going to have something called liquidation preference, which means that in the most common terms, the price that you paid to invest into the company, you'll have the right to receive that price back in the case that the company's acquired, so long as there aren't senior preferred or debt instruments above you. And that kind of baseline protection is something that you often see as an impact in the way that a secondary deal can be priced. So, if you have, let's say we have a recent AI company, and AI is actually probably a bad example. Let's say it's a software company, because all AI trades at a premium right now. But if it's a software company and you're looking at some Series B preferred stock, you may be able to price that at 15% off the most recent round valuation, because of the fact that it has liquidation preference, whereas a common shareholder, somebody that works at the company as an employee, you actually may price that at 30% off. And that just accounts for the fact that you don't have that downside protection in the form of liquidation preference. And I guess the final thing to note on that is I think that that's a really important concept, but also as companies get later and later stage and they're more likely to go public rather than be acquired, that ratio between common and pref will shrink, because liquidation preference is really only relevant in a case the company's acquired in a kind of like a downside scenario.
Awesome, thank you. That brings us right to time. This has been a great sidecar session talking about the secondaries markets. I hope everyone found it informative. Oh, we have one more. If anyone wants to hang out for a minute, we'll sneak one more in here. Looking to the future, how do you see the role of the company? How do you see the role of the company will play in direct share transfers? Will companies embrace SPVs? Phil, you might want to start with that one, since NPM creates liquidity directly with companies, and how you see the market evolving between kind of like employee-led versus company-led.
Yeah, definitely. I would say that there's a few reasons an SPV trade may be occurring. One is because the stock doesn't transfer already, or two, because somebody that owns the stock doesn't want to actually physically sell the stock in the eye of an issuer. Generally, companies will be ambivalent towards SPVs in the sense that they don't know that they're happening. Now, if they do know that they're happening, I think the most important thing that you should consider as somebody that manages an SPV, if you're considering managing one, is how you're marketing and distributing this. If you were in the room with the CFO that you have a relationship with and you've invested in this company, is he going to be okay with the manner in which you're, going out and selling this deal? Or at least are you being, as the other gentleman said, over communicative in the way forecasting the way that you're going to sell the deal. But we operate also, on our side, we operate fully company approved tenders and buybacks, where we'll invite 100 issuer or 100 investors into a deal. They're all approved by the company ahead of time, and so that's not really an issue. But in the sense that you're, operating in an SPV outside of a company approved program, I think that that's really good advice. It's kind of like whatever you do, it's going to be printed on the Wall Street Journal one day, like kind of follow that advice as far as how you sell. And I think as long as you do that, then the company should be okay with it.
Awesome. Thank you. And I want to say thank you to Michele, Phil, Steve, and Max for kind of bringing their insights and experience to bear. Again, Michele is with ARMYN Capital. He's an active venture investor, syndicate lead. Phil is with Nasdaq Private Markets, who provides liquidity and other services in the private space. Steve is with Crosswork, and Max is with Monarch Markets. So thanks, guys, very much. And thanks for the audience who attended. And we look forward to the next sidecar sessions. Have a great day.
Thanks, everyone.
Thanks,
Thanks all.
everyone.